Hello everyone, welcome. Now we're going to explain what volatility is and how it can affect our trading. I guess you are seeing this trend in the 5 minutes chart. You see that it was moving steadily, let's say in an average speed, and then the Bollinger Bands are almost moving in parallel lines. But then, or let's say they are almost moving in a specific angle. But then what happens here? The volatility in this pair increased. What is volatility? Volatility is the speed of price movement at a particular time. So the speed at which it came down and the speed at which it rose back is volatility. You see the speed at which it came down and it means that the market is always volatile. The forex market is always volatile, but at some point the volatility is increased, and we can say that the volatility in this pair was increased at this time. So the speed, it came down. The bears were using high volume to buy, trying to push or drag the currency down. Were buying USD, trying to drag euro down, and that happened. It's a sudden movement downwards. And then what happened? The bulls refused to be defeated, so they bought euro again against USD, and then it went up again with almost the same speed, and now it has even risen above the previous high. So the speed of the market at a particular time is the volatility. And when the market is very volatile, how does this affect our trading? When the market is very volatile, it is very risky to trade at that time, because we know that candle patterns, price action, and things like that can show us if we are in the right or in the wrong trade, depending on the direction of our trade. But if the market is volatile like this and it's coming down, I just sell. Imagine I sell at this point, it will just quickly rise against me again, and within a short time there won't be enough time for me to say, okay, I'm in the wrong trade, I need to go out. No, there won't be enough time for me to say I'm in the wrong trade, I need to go out. Why? Because immediately the price just starts going against me. It will even move sometimes 10 pips before I even notice that it's going against me, and before you know it, it will hit your stop loss. And if you do not place stop loss, that is when it is even more riskier. It can just quickly go against you, and you will just lose more than 5% of your capital, depending on your lot size and the kind of money management strategy you're using. So, like we are saying, when the market is very volatile, moving with high speed, it is more riskier to trade that time. So, assuming I buy because I know that the market is going up from this place. It was rising, and I buy here. If I buy here and this kind of speed happens in the market, just go with speed and hit my stop loss, even though it's going to continue to move in the upward direction. So the volatility is risky in the forex market. However, it can be favorable sometimes. Sometimes you just sell, and before you know, in 1 minute you are making hundreds of dollars, and sometimes even thousands, depending on your lot size. So it can favor you. You can just sell, and before you know, boom, it is going in your favor. But what if that kind of speedily movement moves against you? You see the point? That's why forex traders avoid very volatile markets, or avoid the market when it is very volatile and unpredictable. It's going to break strategies, it's going to break principles of trading, and it's going to break analysis. So that's why forex traders avoid the market when it is very volatile. You just can't tell where it wants to go and how fast it will go there, because if you open a trade in a particular direction and it goes against you with such speed, imagine how much you will be losing even before you can even tell whether you should go out of the trade or not. So that is why forex traders avoid very volatile markets. But what can make the market to move with this kind of speed? Imagine, you know that the distance from here to here was only in 10 minutes time. It's moved so fast like this from here to here only in the period of 10 minutes, because this is a 5 minutes chart, and this is 5 minutes candle, and this is another 5 minutes candle. So the movement from here to here is only 10 minutes period. So what can make it move this fast? News can cause this high speed in movements. It can cause increased volatility. Yes, the news, when it is released, probably an announcement by a political leader or the leader of the president of the central bank of countries that are using the currency that you are trading, or let's say an economic news usually a high impact economic news usually make the markets have this kind of speed in movement. News like the NFP, the non-farm payroll, when it is released, it usually has a high impact on the markets. So that is it's about volatility. It can be risky. Suddenly it can make the market go in our favor and give us huge money in a short time. However, if that move is against us, it will make us lose huge money in a short time too. It is risky to open trades during a very volatile period in the markets, and volatility is increased by high impacts economic news and other political announcements by leaders in the countries that use the currency they are trading, or presidents of central banks of those currency. So this is it for this video. I hope it helps to improve our trading experience and helps us not to be surprised when we see things like that. I hope you subscribe and like, share the video, and stay tuned to the channel by clicking the notification bell. Thank you, and see you next time.